Okay, we're at 63. I guess we should get started. Good morning, everyone. My name is Bud Jones. I'm a partner with Nisivoccia. Thank you for joining us today for another virtual CMFO Roundtable. We have about a total of 70 participants today, including panelists. We're fortunate today to have Dan Mariniello from Northwest Financial Group. Dan's going to talk about CARES Act, SMART Act, and other issues. John Mooney, my partner from Nisivoccia, and John Rheinhardt, administrator, CFO, QPA, and who knows what else from Wharton Borough. We'll be discussing strategies for avoiding deficits during a disruption, and 10-year historical data review and budget projection models. Thank you, everyone, for participating, and it's yours, guys.
Okay, I think, good morning, everyone. This is Dan Mariniello from NW. We wanted to talk a little bit as a session this morning on the two main issues that municipalities and counties and states are really facing off today during this pandemic, which is both the expenses related to dealing with the pandemic, specifically things like testing sites and purchase of PPEs and such, along with the other side of the problem, which is the loss of revenues and how we deal with that. The most importantly, I think, with regards to expenses and how we deal with the reimbursement of expenses. And I think, Michaela, this might lead to us putting up the first polling question that you guys can see, which is, how do you plan on charging your CARES Act funding? There is a part of the federal government's CARES Act funding went to all of the states, and the purpose of that was for reimbursing expenses, not for revenue losses, not for replacing surpluses, not for losses that perhaps were based on issues that you were dealing with prior to the pandemic. This CARES Act money, which was in total in the amount of $139 billion, was specifically put aside for reimbursement of expenses. And I'm going to just put up on the screen here the site that you can go to with regards to the CARES Act. There's a significant amount of information on here. But one of the things that was interesting about this CARES Act money that was sent around to the states and the counties is that it's being run by the United States Department of Treasury. Treasury is typically a grant writing department of the federal government. So to think that they did it all perfectly and right, it would be an understatement. They did not. They weren't sure exactly what to do. The first thing that they wanted to do was get the money out immediately and then try to work through the guidelines on how to use that and how to utilize the money. So if you go to this particular site of the United States Treasury, and you will be able to start to see what this money is being used for. So the CARES Act dollars are only to be used to cover expenses. And they are expenses that are necessary expenditures incurred only due to the public health emergency of COVID-19, nothing else. And as I'll mention later, in all of the webinars that the United States Department of Treasury does, they remind us that at the end of 2020, the Office of the Inspector General is going to be coming in and doing audits, making sure that the money that was spent specifically on COVID-19 related expenses. And if it was not used for that, they will be requesting that money back to the federal government. These are expenses that were not accounted for in the most recent budget that was approved as of March 27th. and that were incurred during the period that begins March 2020 and ends December 30th, 2020. Specifically, that means that you have had to have had spent the money prior to December 30th to be able to be eligible for reimbursement. These are not things that if you, let's say, you contract with a vendor, but you don't spend the money until March, that would not be an eligible expense. And there have been significant amount of webinars run by both the National Association of Counties and the Department of Treasury to go through all of these particular issues. Just because the guidelines have not been laid out, specifically, so that people are sure we know what to do. In some of the counties, we're still getting questions, and I think some of you who are on the call have asked those questions. Because the guidelines are vague, it requires significant thought as to whether or not certain things are eligible or are not. And as you go through this particular site, you can see at the bottom there are a few different PDF files that you can click on. One of the items that I want to touch on here, we can talk through, is eligibility of local governments. And if you scroll down, you'll see how they came up with the dollars per state. And you can see as you scroll through here, based on population of 2019, and as you go a little bit lower, you'll see New Jersey pops up here with a total amount of funding of $3.4 billion. The way that was split up and was that the federal government on a Friday, I forget what day it was in May, had everybody submit their request for funding. And if you were any county, city, or state above 500,000 population, you received money directly from the Treasury. And oddly enough, within a week, money was literally wired to those counties, into their accounts, with almost no guidelines as to how to spend it, other than the site that we were just on. So, as much as it was wonderful that we got all this money, we've been spending almost every day since the middle to end of May, beginning of April, as to how do we do that? How do we spend it, and how do we do it without causing problems and having to give money back to the federal government when this was done? In New Jersey, we had 9 counties, as I'm sure everyone has heard and read, that received money directly. Those counties are Bergen, Camden, Essex, Hudson, Middlesex, Monmouth, Ocean, Passaic, and Union. I'm sure those people who are part of Morris County are going, yes, we know we lost 4,000 people or so. So, yeah, I mean, it was somewhat arbitrary and certainly frustrating. With regards to the counties, the state of New Jersey, out of the $3.4 billion, the state of New Jersey received directly 2.39 or so billion, and the counties that I just mentioned, the 9 counties, received just over $1 billion, $1.05 billion. And then within the counties that received monies, they then can disperse a portion of that money to the local government units. Every county has been dealing with this somewhat differently, but at the same time through consistent calls, trying to make sure that there is some consistency between each of them as to how they're going about in allocating money. Now, with regards to the $2.39 billion that the state received directly, and those towns and counties that did not receive money directly, I know there's been a lot of conversation. There's been county resolutions passed requesting the state to allocate the money directly to those counties that did not receive the money from the Treasury Department. It would seem to, I don't know if other panelists have heard. I have not heard that there has been a decision made on how the state is going to do that. However, in fact, I think I have here in a frequently asked question to the federal government, I'll highlight it here. It talks about this very issue. At the bottom, it talks about the fact that if a state received, let's say, $1.25 billion and had one county with a population over 500,000 that received $250 million directly, then the state should distribute 45% of the remaining amount to its other local entities. And that's right here in the guidance. So if we were going to take that to New Jersey, of the 2.39 or $2.4 billion that the state of New Jersey got, 45% of that, or $1.07 billion, should be distributed to each of the other counties that did not get money directly.
Again, I haven't heard anything specifically other than county officials have been contacting their area legislators to work on their behalf to try and make sure they get a piece of those dollars.
Hey, since Bud already interrupted, we didn't make the announcement at the beginning, but in order to qualify for getting your CEUs for this webinar, you need to answer 3 of the 4 polling questions. We only had 41 people out of the 63 respond to the first poll. I think we should just relaunch it, just since we didn't make that announcement. Sorry,
sure. There was a polling question that we had up earlier. Yeah, so we have not heard, as you just heard, how the state is going to do that. However, I believe, just to give you an idea, I'm going to stop this share for screen for a second and start a different one. And I'm going to show you I'm going to switch this one over here. I think this is how I do it. Let me just make sure I know what I'm doing here, as opposed to the registrants. This is, John, can you see this spreadsheet now with the counties?
Yes.
Okay, so this is just a brief, I mean, I put this together just so that you all could take a quick look. Of the $1.07 billion that should be dispersed to the counties and local governments that did not get money directly, this is the split right here as to what each of the additional counties should be receiving. So as you can see, Atlantic County 99, Burlington 167 million.
And I'm seeing the list of attendees.
Yeah, I don't. Okay.
Oh, I'm sorry. Let me just. Is that it better?
Yes.
That's the one.
Thank you.
Thank you. I've only been working home for 3 months now, so understanding how to do it is new. But anyway, so as you can see from this spreadsheet here, at the top, it's $1.07 billion. Each of the counties that did not receive money directly based on their populations would be and should be receiving this amount of money from the state of New Jersey. Significant dollars. And then, as I've done below, I have myself split based on those numbers to each of the municipalities within those counties. And I'm happy offline to send something like this to each of you to make available, or you're welcome to give me a call to talk through what some of these municipalities should be receiving from the state of New Jersey. Let me go through. So there's here just to. Lost my place on my screenshot, but let's just go here. So nothing's shared at the moment, right?
Right.
Okay.
Right.
Right.
So just to continue on, my suggestion, as I think we've seen from what other counties have done, is push and push your county leaders to continue to push and push your state leaders to make sure that that money gets distributed. I'm going to touch back a little bit on while you're doing that and in contacting your leaders, what you should be doing is taking note of all of the expenses that you are incurring based on COVID-19. We've put together a significant amount of frequently asked questions that we've received from certain counties that we are working with, and it's very interesting to see what should be being done and what can be reimbursed. And it's really difficult for those towns and counties that did not receive money from the federal government directly to know what there is out there that they can spend and how much can they go up to knowing they're going to get reimbursed. These are things, so the Treasury Department talks about them and splits them into a number of categories: medical expenses, public health expenses, payroll expenses for staff that is working specifically towards responding to mitigating COVID-19. The federal government talks about a quote, out of title use of an employee. If you have somebody that's in the finance department, but for the last 2 months has been working specifically to mitigate COVID-19, then the last 2 months of their salary and benefits would be reimbursable, and it adds up. Expenses associated with other COVID-19 related expenses. One of the things that was very interesting that came out after a while through the frequently asked questions was the cost of issuance and interest cost on tax anticipation notes. So if you are a community that because of delayed tax revenues, lack of tax revenues coming in as it relates to the pandemic, and you need to issue TANs to make up the difference until you get that cash flow back, the cost of issuance and the interest expense on those TANs, as long as they mature by the end of December 30th, those expenses could be reimbursable through the CARES Act money. We've seen a lot of items such as all non-touch type of changes to entryways, to water fountains in parks, to soap dispensers and stuff, flushing mechanisms in toilets in the municipal buildings. Anything that you can do with regards to public safety, social distancing, putting up partitions. There have been a number of requests as to how do I change the internal workings of the municipal buildings so that people can come in one way, with partitions, see and get what they need to get, and then walk out the other way. And the cost of making that happen is reimbursable. We had one community come in and look towards creating all electronic documentation software such that people do not have to go into the municipal building to receive permits, licenses, and other registration forms, that it could all be done electronically through a document sharing system. All very important things that meet the requirements of the public safety due to the pandemic. As I mentioned before, one of the things that you have to remember is that it's truly an expense-related issue. So and it's a reimbursement program. So you have to spend the money to get reimbursed the money, which is why it's so important for local towns and counties to know that they have this money out there and the ability to be reimbursed. In some counties, we have actually, allocated a dollar amount to each of the towns so that the towns knew and know between now and the end of the year what they have that they can get reimbursed for. And I think that that gives a lot of comfort to towns knowing that it's there for them. In other counties, we have mentioned that the money is made available to all the local governments, but no number has been put on it because they just don't know to what extent the dollars are going to be needed per community. So we've just sort of left it open. Interestingly enough, the CARES Act also allows for monies to be given to small businesses and business interruptions. So any business, non-essential retail, leisure, recreation businesses that were shut down as a result of the executive order also can receive CARES Act money. Now, that doesn't mean that all of the counties that receive it directly are providing reimbursements or business interruption money to small businesses, but I know a number of them are trying to work through a program that makes sense to be able to do that. It's a little bit more difficult to get through that process. But again, the most important part of this is it's a reimbursement. The Office of Inspector General is going to come in and do an audit. One of the things I wanted to mention, I didn't have on my notes was, and I've learned this just through talking with a number of people who have been dealing with this, is there's also money that has been allocated to FEMA, and FEMA has its own separate application process. And one of the important things to note, if you have not opened up a project worksheet with FEMA, the FEMA money doesn't end as of December 30th, 2020. This CARES Act money is done and over. If you haven't spent it as of December 30th, it goes back to the federal government. The FEMA money, however, if you open up a project worksheet with FEMA now, even if it's a smaller amount, and you know what you've spent thus far and what you expect to spend, let's say, I think they do over a 6-month period, and you get to a dollar amount of, I think it's $130,000 or somewhere around there, then that opens up the portal and it keeps it open beyond 2020 into 2021 and beyond. And that's important because, we're all pretty sure that this is not a 2020 problem. This is the 2020, 21, and who knows how long. So if you do have expenses that you're going to end up seeing into 2021, my suggestion is to look at the FEMA site, and it might be the right move to open up a portal now, so that's available to you. I don't know if we want to put up another polling question now.
Actually, Dan, we do have a couple questions. So one of the questions, the questions up here is, so is the state of New Jersey funding directly the local testing sites?
Those that I've been dealing with, the answer would be no. So the county testing sites that I have been working with, all been funded by the counties themselves directly.
There's a second part of that question is there funding going to the CVS stores, or is that solely being funded by the corporation? I don't know that answer.
It's certainly not through the CARES Act monies that we are referring to here. So CVS, through, for example, there was obviously the PPP money that went into, businesses, but I'm not sure I don't want to speak to the CVS money here because I'm just not sure.
Okay. And then we have another question from Chuck Kucha. It says, since we're now working with restaurants to dine outdoors in parking lots, we need to address traffic safety. Can the municipality purchase traffic barriers to protect restaurant patrons when they're dining outside in the parking lots?
So as my good friend Chuck knows, in Passaic County, we've set up a specific email address for all questions to come in. And then what happens is once the questions come in, we review them as a group, and then we submit the answers back with the recommendation from the county. My suggestion to you is if you do not have, if you explain that you do not have enough of those barriers currently and they're needed just specifically for this issue, it would seem to me to be an eligible expense. But Chuck, I encourage you to submit that question to the county.
John, there were some questions posted via the chat. Did you see those?
I am now. I wish there was just one place to get questions. He's making this difficult for us.
Well, while you're looking, Laura had a good idea. Dan, you had mentioned the frequently asked questions. If people are interested, we can either send them out to you or we can have them posted on our website so you can go and get those frequently asked questions.
Yeah, and I think what I can also do is the federal government put out these frequently asked questions, which I have on the screen right now. It was updated as of May 28th. That's on that same website that I showed you before at Treasury. In the meantime, there have been other questions that have come up at the county level that I've been working on that I can also Bud send to Mikhail, or however you want to send it out to this group, because there's been, as we found out, the reimbursement application process, the actual application that we put together for towns to fill out is seemingly not that difficult and somewhat straightforward. It's the questions as to whether or not things are reimbursable that's taking a really long time, because because there was not a true specific guidelines by Treasury. There's just so many things that are up in the air, and that's really what's been taking most of the time. So we've put together an FAQ based on what we've received from some of the communities that we've been working with. So I'll send that Bud as well.
Great, thanks, Dan.
Yeah.
And if this is anything like the PPP program, it seems like the rules are changing as we go along also, just because it's so new.
So there's a couple more questions here. This next one might be more for John Mooney. It says, if you qualify for these funds, how are they handled? Are they handled as a Chapter 159 or as a budget credit?
I haven't had any guidance on this yet, so that's a good question. I'm not going to put Bud on the spot like you just put me on the spot, but at this point, I would think that it would come in as a credit if we're keeping track of the expenses and we're running them through the budget. As these funds come in and we're reimbursed for the items, then I wouldn't see it being a problem if we offset those expenses with an appropriation refund form. If we do it as a Chapter 159, we're going to wind up reclassifying those expenses out to, or even leaving it in for those for whatever line items it's being charged to, but we will have to capture it as a revenue side item as well. So I haven't seen any guidance as far as what we are going to do with it. However, either way, in my mind at this point, it's acceptable because, again, there's no guidance, and you're doing really the only two options that you could do at this point. So, like what you just alluded to, things change by the day, and that's what I'm waiting. We'll wait for more guidance on that. Go ahead, John. Sorry.
No, I think Dan actually had an answer to that.
Well, I was just going to say, I mean, there are some people who are in the group that I think from Passaic County. In Passaic County, they submitted a grant agreement to each of the communities, and each of the communities passed a resolution. And I think that they're all having it as a Chapter 159 revenue. So, I mean, I'd leave that up to some of the locals who might be even on this in the group, but I think that's how they're handling it, at least in Passaic.
But, ultimately, we're still going to have to track this as a grant, and it's still going to have to run through the federal and state grant schedules. You're getting grant dollars, even though it's a reimbursement. when we do have FEMA reimbursements, we run those through the grant schedules as well, ultimately. So we will account for it as a grant. But again, at this point, I could see us reimbursing the areas of expense that we have first, and then we'll figure out what to call it after that.
So we have a couple more questions here. It says, are estimated billings included in those expenses since this would not have occurred normally?
I'm not necessarily following John with what estimated billings.
I'm sorry, estimated taxes. So traditionally, most of us are, I understand other than Essex County, but most of us have our budget certified and the tax rate certified, and we can issue our bills in a normal cycle. Since the state is not going to adopt their budget until September and they change their year end, that changes the final certification. They can't certify the state aid numbers until they're done with theirs. So which delayed us back into beyond the third quarter. So all of us have to do estimates whether we're normally doing it or not. So it is a cost that's directly related to this event.
I mean, I think my thought on that would be if you typically do estimated regularly and there's a cost to that, and this time that you're doing so many more estimated and there's an additional cost, that additional cost, I think I would say would be eligible, but not the entire cost because you typically have that anyway.
Bill Homa has a question here. I'm not sure what he's saying. Will the municipal auditors, as a part of the audit, be testing that the expenditures were made in accordance with the established guidelines?
Oh, yeah.
There's your answer.
Yeah.
It's going to be, look, it's going to be a high risk. This is new for everybody. So it's a new grant that comes on board. And, depending upon the level of dollars that towns are receiving and counties are receiving, I mean, I'm sure it's going to break the thresholds and high risk. So, yeah.
So actually, Ray Sarinelli made a good point. They changed the rules during this event to allow us to charge expenses against the storm recovery reserve. So obviously, if we expend out of that reserve, you can reimburse that reserve.
Yep.
Right, and as regards to whether we're going to audit, I think to a degree it depends on the level of funding that we receive. It may be below those thresholds too.
Okay. And then we had another one out of Hudson County who said that they've got a similar program that they created essentially a grant agreement.
Okay. Yeah, so you can see that there's different experiences throughout the group, and I don't necessarily. I think the only wrong answer that could be out there right now is if you just took the money in as miscellaneous revenue and moved on. I think it's got to be associated with either a grant or a reimbursement to where you've been charging your expenses to. I think at this point in time, things may change this afternoon, but at this point in time, either of those are acceptable right now because where else are you going to put the money? I mean, it's a logical approach to the problem we have at hand.
I agree. I think we just need to be flexible with whatever we do.
There seems to be another question that came in here on type of payroll expenses that are covered. Is it limited to overtime generated directly to COVID response, or is the funding also covering the cost of COVID quarantining of first responders, salary and benefits? I would say all of these questions, the more specific from an example that is given, the better you can answer. But I will say that overtime for employees that are responding to COVID-19 would certainly be a reimbursable expense, including the salary and benefits of those employees that are specifically working on COVID-19 related issues. The quarantining issue has come up on a number of different questions that we've had in a few of the counties, and it depends on what we're talking about. If you have employees that either were sick or came in contact with someone and need to be quarantined, and either work from home or go home, their particular salary and benefits wouldn't seem to be reimbursable. However, if you had to then replace that person with somebody else to do that person's job, then that person's salary and benefits, or perhaps you were hired somebody part-time to fill in, that person's salary and benefits would be. If you had to quarantine people in a hotel as opposed to home, and you had to put up, rent the rooms in the hotel, that's a different issue. That would seemingly be a reimbursable expense. Now, I'm saying this all without, the county's specific approvals on this. All the questions that have come in are not answered by one person just because everything is so vague. We have a pretty large group that we run through all of the questions through and then get back. But Gabby, I think, that I try to answer that question the way you sent it, but if there's something specific you want to chat about, let me know. There's another question here. The grant agreements with the counties and municipalities are for the counties that have direct funding currently, correct? Yeah. The monies that we're talking about now, unfortunately, are only with regards to the 9 counties. Prior to as soon as the counties received the money, those 9 counties received the money from the federal government, there were a number of conference calls that those 9 counties had together. I mentioned somebody from Hudson on the call here. Hudson was a real leader on those calls. And I think they perhaps were even the first to come up with the idea of a grant agreement. And it seemed to make sense. I think each of the counties, I can't speak to all the counties, but I know a number of them have adopted the idea of the grant agreement and allocating a specific number of amount of dollars to each of the towns.
So Dan, one of the questions is Jonathan DeJoseph's asking what fringe rate is being used by the municipality for FEMA or CARES Act claims?
I don't know the specific answer to that.
So, I mean, I can answer what we do here in Wharton is we take advantage of the fact that Morris County as a county comes up with their own fringe rate study every year. So I asked for a copy of it since they're putting all the work in. I figured they've got a larger employee base. So I use that fringe rate study as the basis for anything that I use for reimbursement. We have another one from more of a statement. Fabiana from Lincoln Park is saying that when they had somebody that was quarantined, they submitted as a workers' comp claim, not as a CARES or anything else. It's probably a good time to launch that second polling question.
Sure. This goes back to this, we were talking about the 9 counties and why the 9 counties received money specifically as opposed to all of the counties in New Jersey. Again, if you're in one of the counties that did not receive CARES Act money directly, I can't stress enough how important it is to, one, make sure you're keeping track of all of your expenses that you are spending specifically to COVID-19, and then constantly keeping in contact with your county officials and your state legislators. There is no reason why the state shouldn't have already allocated money to those counties. I've seen it just in the places that I've been working with. It's almost impossible for people to truly provide the support to the citizens, whether it's social distancing requirements and other public health and safety stuff, if they don't know that they're going to get reimbursed, which I think takes us to another part of the conversation, which we'll touch on relatively quickly, which is the reason for that is because you communities are already losing money. It goes to the loss of revenue side of this discussion. So if you're losing money on the one side, but you have to spend additional money because of the COVID-19 pandemic, and you don't know if you're going to get reimbursed or not, that causes a significant problem. Is that right?
73% of the people were listening to you earlier. So we had 73% or 43 people that had the correct answer. The rest, we got to play this over again later.
Gotcha. There was an interesting issue, as we mentioned before. It was such a close. So many counties were so close with regards to their, whether they made the population requirements or not, right? Those on this call that are from Morris County are probably 100% sure of what the population threshold was to receive CARES Act money directly, since they just missed it at about 496,000 population. But it's important, I think, that you continue to keep track of all of your expenses and talk to your legislators. Because if you were not in a county over 500,000, then you did not get any money. Should we start moving over to the loss of revenue side of it, John?
Sure. Are you done with yours?
Well, I was going to talk a little bit about the few things that are out there with regards to loss of revenue. I'll just touch base on it real quickly. Right now, there is nothing that allows municipalities or counties to either get a loan, borrow money, or do what they need to do to replace the lost revenues that they're seeing as a result of this pandemic. Some communities are finding that they're not losing too much revenue and they're able to get by with surplus. But many towns and counties, especially the larger cities, have lost significant dollars. Whether it's parking revenue, ticketing, hotel tax. Newark, we have car rental payment tax. We share money with the Port Authority. There is significant loss of revenues. And the question is if the CARES Act money doesn't cover it, how do we make up for it? So right now in the United States Senate, Senator Menendez and I think Senator Cassidy from Louisiana originally came up with what they're referring to as the SMART Act, the State and Municipal Assistance for Recovery and Transition. And that is there in the intent of that is to try and get, I think the total dollar was $500 billion into the hands of state, county, and local governments for the purpose of replacing lost revenues. That bill is currently in committee. I think the Senate just started up again on June 1. It has not come out of the Committee on Banking and Housing, so we'll keep track of that. The way that broke down real quickly was $500 billion, $16 billion of it set aside for Native American tribal governments. Of the rest, they were splitting it up in three ways. 1/3 goes to all of the states based on population. 1/3 goes to all the states based on their share of the infection rates of COVID-19. So now you have an allocation of money directed more towards those states that were hurt the most because of COVID-19, which is something we hadn't seen yet. And then another third of it based on lost revenues and what your percentage of lost revenues in one state versus the entirety of the nation. So again, now you start to see where they're trying to get the money in the hands of the most needed and most needy of the states and communities. There's not a lot of guidelines on that money. If it did get passed, we're not sure of how that money is able to be used. Can it just automatically go down come in as miscellaneous revenue and help to balance your budgets? How much would each town get? There is some guidance of it, but not enough to really go through and understand the extent of this. I think more importantly than that bill is the legislative action that's going on here in New Jersey, specifically Assembly Bill 3971, and I think the Senate bill is 2475, if I'm correct, John.
Correct.
That is being referred to as the coronavirus relief bonds. Basically, that legislation creates the ability for towns and counties to borrow and finance initially short-term, but eventually long-term for the loss of revenues. Its intent is to provide funding for the loss of revenues in 2020 and 2021, because we know that this is not a one-year event. It allows for an initial short-term borrowing, and then eventually you could borrow up to 10 years. You could go longer if you want to apply to the local finance board, but 10 years would be the maximum without having to go to the local finance board. With regards to the dollar amount, the maximum amount borrowable, I think that's a word, is up to 20% of your budget without having to go to the local finance board. Of course, you cannot borrow to the point where you go above your debt limit. There is a corresponding bill, I think, through the governor's office that is in the assembly that really, in my opinion, falls short as to what local communities need. It sort of takes the control out of the local town and county's hands and puts it back in control of the state. That bill 4175 authorizes the state to lend money to the governments, not that. So we're not borrowing from the investors from the market, we're borrowing from the state. And just to give you an idea, if the state was to borrow money, their intent would be to borrow money from the municipal liquidity fund that the federal government set up. As of now, depending on where the state financial position is and what their credit rating is, they would be able to borrow from the municipal liquidity fund at a rate anywhere from 2.7 to 3.8%. And if any of you all know and have gone out to issue short-term notes recently, the market has really come back after an initial hit in March and the beginning of April, to where now you're starting to see towns and counties borrowing at sub 1%. So to think that that bill is a better answer than the coronavirus relief bonds is really hard to get your arms around. One, all of the control is with the state, and you're borrowing at a cost of funds that is, 3 times what you could borrow on your own. My suggestion is for those that haven't read the bill, it's out there, and a lot of towns have actually created passed resolutions in support of 3971, which has been passed through the Assembly. 2475 is the Senate sister bill that we're hoping that gets passed shortly. If there are any questions with regards to those, I'll be happy to chat with them. But other than that, John, I think I am finished.
So 2475 was supposed to get to before committee yesterday, and it was pulled at the last minute by the Senate president, who is not a fan of that bill. So I think that's important to note. I know initially he said that he hadn't heard from any of his mayors or towns as to why that bill was needed. So we pushed out a message, and hopefully he got the message, but apparently not completely, because was pulled from committee. One of the new questions, and this is another Bill Homer question. John Mooney, you doing hashtags on every time you ask a question?
Yes.
And Bill, we do love your questions, but we have to pick on you. He's asking if the issuance cost incurred by the municipality can be charged against those funds that are borrowed, or against even the CARES funding.
I had mentioned earlier, if you're referring to issuance costs related to tax anticipation notes, specifically related to loss of revenues due to COVID-19, yes. The coronavirus relief bonds, if you're referring to those costs of issuance, I don't have an answer for you yet. It's, it would seem to fit. It hasn't been a question asked to Treasury yet because it's not even in existence at the moment. So the question hasn't been asked.
Fair enough. Okay. We'll move on.
Do you want to move on from here?
I'm having some technical difficulties with my connection, so just bear with me.
Sure.
Always happens, right? There was an article that was back in June of 2019 in the GFOA Nationals magazine, which is referred to as the Government Finance Review. I remember reading the article back in June. It helped me in guiding a lot of what I do in reserving. So we had taken some of those practices, not as in depth as they did, but it seemed like a really good time to share that article. And we'd be happy to share the article too, if everybody would like a copy of that. The article is written by Shane Kavanaugh. Shane is the Senior Management of Research at GFOA. He does some crazy things. I actually sent him an email yesterday. He said, hey, thanks for your article because I'm going to use it in a seminar tomorrow. Haven't heard back, but some of the stuff that he's been doing is pretty cutting edge. It's neat to see. So one of the things they talk about, and this is all from his article, is financial reserves or rainy day funds. It's there to safeguard us from things, and that's the only thing to put it, from recessions, from, extreme events. We've had all these crazy storms in the last several years, and now we have COVID-19. And you think to yourself, could I have prepared for COVID-19 ahead of this? And I'm going to tell you, I think the answer is yes, but I think it depends on the level of which you reserve. John, actually, I'm going to have you interject first before I go further.
Sure.
We're going to cover some of the other items. I jumped ahead of you.
Right. No, one of the things we were looking to discuss here is to help you. I guess this is twofold. One is to help you with the rest of the year here. And the second part of this is going to be how do we address, creating reserves and putting ourselves in that better situation going forward. A lot of it has to do with, making sure your reserves are stable without overtaxing your tax base. But, some of the reserves that we've been discussing in a few of these roundtables and even amongst ourselves as a group at the firm, the Storm Recovery Trust is first and foremost. John, I don't know if you have slides on these later on, so I don't want to step on what we're going to overlap with here.
No, we're good. Keep going.
Okay. So the first one that comes up with how are you going to get through this year with a loss of revenue? Because like Dan was saying, there's not much out there. There's nothing that we know of that's going to help protect your revenue side of the ledger. So you're still going to have expenses and you're still going to have, things that you're going to have to deal with, but you're going to have a loss in revenue one way or another this year. And what can you do to slow down or prevent having a deficit in operations? And, early on this came up with the Storm Recovery Trust. The Storm Recovery Trust can't be used unless the governor declares a state of an emergency. And he has. And this is one of you can charge your COVID expenses to the Storm Recovery Trust. And I always learn better through stories. And I'll just tell a quick story of a town that we audit. And, I've been going back and forth with the CFO in that town. And this was prior to the AFS being written. So this is all pre-COVID. And the town's in pretty good shape financially. And one of the things that we were engaged to come in 2 years ago, and now this is our third year. And we want the town to develop their trusts. We want them to grow their trust funds. They're sitting on a healthy surplus, but they have nothing in reserves. So we suggested that they move about $75,000 worth of appropriation reserves that they didn't spend into that trust. And, the CFO was fighting me on it, saying that we never use this money unless there's a state of an emergency approved by the governor. And how often does that happen? And my argument was it's been happening more frequently than not. So it's not like you're just going to squirrel it away and never going to be able to use it. And, I've won in arguments before with the CFO, and she's a good friend of mine. And I said, you know what? I'm not going to die on this hill. And I said, if you don't want to do it, that's fine, but we're going to bring it up to the committee next year, and we're going to have them, make a decision on what they want to do. So we didn't move the 75,000 in. We could have, and here we are, having COVID expenses that are being charged directly to the budget this year. So I really believe, I'm a firm believer of, if you have a fund balance plan in place, and you're able to maintain that fund balance plan each year and even do a little bit better, then maybe it's time to start putting more money aside into reserves for these rainy days. And this being one first and foremost. Another thing that we look at of how you're going to be able to help yourself and other reserves that you may have. One of them is the reserve for pending tax appeals. The reserve for pending tax appeals, you should be in touch with your assessors. Your assessor should have an idea of what you are facing. Sometimes there are some towns that have pretty large reserve for pending tax appeals. There are other towns that have nothing. So if you do have this, it's time to look into this and maybe have a cancellation of some, if you can, of this reserve during the year. I know one of the things that came out recently was that there was an extension given. And before we wrap up today, I'm going to go through Local Finance Notice 2020-13, which goes over the extended deadline periods. But one that's not on there that has come up, though, is that the timeline to issue a tax appeal has been extended to July 1st. So that's been pushed out. And also the timeline for judges to render decisions on the tax appeals has been pushed back to September 30th. So there could be, unfortunately, we're telling you in one hand, maybe it's time to look because it might not be so bad and you can cancel some of this. But then again, this year, everything's being pushed back, and so is the deadline to file the appeals. So you got to be a little cautious with this. Maybe consider doing it after July 1st. Take a look at where you're at with your assessor. Put a game plan together. Do you have enough in there? Do you have too much? Or maybe you don't have enough at all. But it's another reserve that we would like you to look at to help offset any operating deficit. I know that there's a question down there. We want to get in as we go here.
Give me 1 second. Sorry, I'm muted because I had a lawnmower in the back of me as well.
That's okay. Maybe we'll hit that when we get further into the next topic because it has to deal with constant increase in fund balance.
You got it, Bill. We're going to put you back on the shelf. We'll get to you later. Some other areas that, as an audit firm, and I'm not, I'm part of Nisivoccia. We help run the program, so I can a little bit about what we do and what I do. One of my jobs when I come in is I take a look and see how your financials look, when we take on a new client. And, there are some instances where I know this 2 years ago, I canceled off a receivable from a county for open space for an ordinance that went back 20 years. So how clean are your receivables and how clean are your reserves? And do you have money sitting in reserve that you haven't looked at in a while, specifically grant reserves? So if you have grant reserve money that's sitting out there, that's not offset with a receivable that's still out there. You've received the cash, you just haven't spent the money. The grant goes back several years, maybe back to 2010 or 11, Maybe it's time to look at those reserves as well and determine, am I going to spend this money or not? And anytime you cancel a grant reserve, it goes right back to your bottom line. So again, if you were canceling off receivables, it would take your surplus the other way. So you have to really balance out the two and look and see what's collectible and what's not. Normally, we would tell you to look at both receivables and reserves. But for purposes of this conversation, we're trying to find ways for you to have a better surplus by year end, or at least to make up for that loss in revenue. So I'm really pushing that you look at reserve balance here and see what you cancel out.
Hey, John?
Yeah.
Just like you're saying, when we review a new client, we ask them to look at those items, I think, pretty much across the board. And what we've found in a lot of instances is there's a lack of communication between the departments that have the grant and the finance office. So those reserves that look like they're unspent have probably been spent, just not charged properly.
Correct. Yeah, I've seen that too. And even with the receivables, when money has come in, depending upon the CFO, I'm not throwing anybody under the bus specifically, but sometimes receivables, money comes in and it doesn't get posted as a receivable. And that receivable hangs out there for years and years and years. And they collected it 10 years ago. It shouldn't be on the sheet. So, it's another one of those communication type issues or just an error in posting type issues. But just to come in with a clean set of eyes and say, do we need to have all these ordinances sitting out here or all these grants sitting out here? It's something that you should be looking at. And I just mentioned ordinances. I mean, it's not going to help you out with any operating deficits, but ordinances as well. I mean, if your ordinances are going back to 1999, maybe you should be looking into it and seeing, the project should be done, so let's get the money back to its original funding sources. Same client, we were in a position to put over $200,000 back into capital improvement fund, and it's a smaller town. So, they had the option then of not putting capital improvement fund into their budget, but we advised against that. Keep making your annual contributions so that you don't take it out of the budget and that you don't have any cap problems with your budget, because removing the capital improvement fund dollars would put you in a situation where you could be looking at a smaller cap. So I think it's very important just to clean up items that you have within all your funds, but specifically your current fund this year. One of the things that we preach, and I live by, a former partner of mine, a huge mentor, and he always, and I'm sure all my other partners think the same way, but with reserve for sale of municipal assets. You have asset money that comes in because you sold either a piece of land or a piece of equipment, or maybe you foreclosed on some property and received the proceeds. We don't like to see that used as a one-time revenue for budgeting purposes. So if you sold a piece of land for $200,000, we don't want to see you bringing in $200,000 next year in the budget just so that you can reduce your tax rate or hold your tax rate flat, but rather use that $200,000 for a one-time expenditure that you have. Maybe you need a piece of equipment, and you can bring in the piece of equipment into your budget, and you can offset it with your reserve for sale of municipal assets. But that's another area that if you have a lot of money sitting in your reserve for sale of assets and you're facing a deficit, well, maybe it's time to look at canceling off that reserve or a portion of it to help out during this year and get you through this crisis. We always try to budget with multiple years in mind, but I hate this term, and if you've been on these before, you've heard me before, when people say, well, we don't know what the future is going to look like. Well, nobody knows what the future is going to look like. If I knew what the future was going to look like, I'd be sitting on a beach right now because I would have invested in Google a long time ago and cashed out at this point. But, I'd be there with a mask on, but socially distant from everyone else, but I still wouldn't be in this conversation right now. So with that said, we don't know what's going to happen or how long this is going to last. People are predicting a second wave, but who knows? It's very unknown at this point. So if you have an opportunity to help yourself out this year because you need to help yourself out, we'll focus on next year. But we'll try to plan with a plan in mind to help you get to that next level next year, because it's going to be an impact on how we do things in 2020 when it comes to budgeting. But right now, some budgets are not even done for 2020 yet. So there's a lot in play here, and we're just looking to find different areas and different pots of money that you may have that can help you get through this year without any kind of operating deficit. The last item that I really have to go through here is the deferred school tax. And again, I brought this up last time, if you were on last time with the roundtable. The deferred school tax is unique to some municipalities. It's not unique to everybody. You either opted in or you didn't. And those towns that have deferred school tax, I don't recommend personally that they increase their deferred school tax to keep their taxes low or taxes flat or bring it into the budget year after year. I say sit on it and let it grow until it starts raining. Well, it's raining. So if you have a reserve out there where you can increase your deferred school tax, this would be the year you would probably want to do that. I don't increase the deferred school tax for expenses. I don't use it as like the sale of municipal asset reserve. I don't use it like that to try to get items purchased. I try to keep it there for a rainy day. The year where you have a bad surplus or a surplus is low, or you haven't recovered the surplus that you used in last year's budget. That's when we look to, increase that deferred school tax a little bit. It's an artificial inflator. It's not the best thing in the world, but it's an option. And if you did have an operating deficit and you went down to Trenton to have to explain it, the first thing they would ask you is, do you have deferred school tax? And are you at the max? Because if you're not at the max, that's the first thing they want you to do, is to increase that deferred school tax to get rid of your deficit. So you do have some options. I can't say all of them are excellent, but they are options that are available. And we're going to see new things as we go through this, but these are the ones right now that are kind of like low-hanging fruit. If you go through your balance sheet for your current fund and you see other reserves that are on there, I know there's some emergencies that might have taken place in your municipality years ago. I know of one in particular where there was a fire, then there was an emergency set up for it. Maybe 75% of that emergency was actually spent. So we're still carrying a reserve on the balance sheet for about 25% of those expenses. If you know that you're paid out, just like it's similar to the grant fund, if you know you have open dollars in there and you're not going to spend them or haven't spent them, let's clean it up, and it makes me feel better as an auditor. It's one less line to cross-reference through the audits while I'm reviewing them. And it shouldn't be on there if you have no intention of spending it. So those are my areas for the reserves that I wanted to touch on briefly before we get into how to increase those reserves and help out going further. Because at some point, the skies are going to be blue again and we'll be back in business, and to get everybody on track to make sure that they're prepared for another emergency. I'm not even going to say another virus, but another emergency in one way or another. Hopefully we won't be hit with any October snowstorms and blizzards that knock out power everywhere. And, but it could be right around the corner. So best thing to do is be prepared for it. And that'll lead us into our next segment here.
Well, before we move on, we actually, Bill has another tally mark on his questions.
All right. I think Bill's up to 5 today.
So he says, as instructors who direct his courses, that he instructs the students to monitor the balance in the appropriated reserves versus receivables for these grants. If there's no funds in the appropriated reserves and there is a receivable, then the students are instructed to find out why it has not been collected. So that's actually could end up as a deficit, not as an excess. So that was more of a statement than a question from Bill.
Sure. And one of the things that we'll look at, and I go through with my clients as well, is that, if there are receivable balances out there that maybe you've collected in the past, but they're so old you're not going to receive them even if they are valid. If you have a good year fund balance wise, rather than putting money back into reserves, maybe it's time to clean up the old receivables, or just bite the bullet, take the hit, and get it off your balance sheet and move on. But Bill's absolutely right. I won't count that as a question. That was more of a statement.
Okay. No tally mark, Bill. So John, back to your reserve for sale of municipal assets. I have to tell you, we sold a piece of property here in Wharton when I first started back in 2004 for about $2.2 million.
Okay.
And what we're doing is we've been slowly matching that to major capital projects, and we've been redeploying no more than $300,000 over a period of time, and we're still maintaining about $1.3 million in there. But for us, it's a cash flow gimme, because we've got it sitting there on a balance sheet, but it's one that we redeploy with a stated purpose each time. So that's an absolute great strategy.
Sure. I mean, for us, it's a one-time revenue means it's a one-time expense. So once you start plugging your budget full of one-time revenues, you're going to face holes in the subsequent year. So it makes no sense to, imagine if Wharton took that money and put $2.2 million as a revenue back into the budget the year after you collected it. Now go into the third year or the second year there, and where's the 2.2 million coming from? So we want to do everything to keep the tax level, maybe creeping up slightly, because, the best run towns that I have just increase to keep along with the cost of living, but we want to avoid the major fluctuations in the tax rates. And, if you have a piece of equipment that you sell, then use that money to go buy another piece of equipment or a project or whatever one-time expense you have.
Absolutely. So Bill said, thank you. So we still have that one question of his that we will answer later.
Yes.
So I have to tell you, I received the best compliment ever. I'm talking about rainy day funds from my finance chair, who said to me, she said, you warned us this was coming. And we have been building up reserves slowly, but not overtaxing, not beating up our residents, but just building them up over time. And we are ready, which is nice. But it was nice to hear that she was listening. So actually, before we go to the next one, you talked about different tactics, canceling reserves. You said, is there a tax appeal? Do we have litigation reserves? Anything sitting on your balance sheet, I think, is fair game as long as it's not accounted for something specifically. And any of those cancellations will offset those deficits in operation. That's a strategic move, I think, that you do when you're writing your year-end financials and you figure out what you need to just stabilize and to recover. So on with the presentation. And I'm going to minimize all these other screens so I can see what's on mine. So John, if you see any questions, if you could moderate them.
Sure.
So the article goes on to say that the perennial question about reserves is how much is enough? If you've got too little, if you haven't prepared for this event, if you haven't built any reserves ahead of this pandemic coming on board, you're going to need help. You're going to be hoping that bill 2475 passes, which we don't know that that's a guarantee. But you are absolutely going to need help, and you have to finance your way out of this. If you've got too much, the question is, did you redeploy taxpayer monies in a way that wasn't prudent to the town? Are you failing to make investments in infrastructure? Those one-time things that we take out of that reserve for sale of municipal assets. You could have redeployed those reserves for that. But again, how much is enough? So in reading the article, they recommend that the GFOA recommends maintaining at least 2 months or 16.7% of your budget in the form of reserves. If you listen to Moody's, traditionally they're looking for 24%, which is about 3 months, to become a AAA rated community. But depending upon your revenue makeup, you've got different sources of revenue that are all over the place. Those of you that have been on this before, we know that like New Brunswick, I was talking to the CFO of New Brunswick, Doug Pettix, and he was talking about they're starving for revenue on their parking utility. Or a parking authority. So that's one source of revenue that doesn't impact me. If you're the shore communities, you're dealing with, beach fees. You also have parking down there. So every community has its own issues, which makes you realize when you're boring and plain, like my town, that it's not as horrible, but it makes it nice. So the next question was, what are your risks and understanding them? So it talked about, what is the probability, and I rarely read from a slide, but I'm going to read from some of these because it came right from the article and I don't want to bastardize the article. But what is the probability and magnitude of the loss? So how do you figure that out? And then you need to quantify what your risks are. So what are the risks that a town is subject to? We know that the natural disasters are a complete issue lately, especially with these mega storms we're getting. We also have tax appeals. We've got litigation because everybody wants to sue us because they think we've got deep pockets. We've got the snowstorms, the hurricanes. And then you read these articles about the people that retire and they have their boat fund where they're getting paid, $250,000, if not more, in these payouts. But when you compare those things, the snowstorms, the tax appeals, they all seem like a really basic, simple thing that you can plan for when you compare it to this pandemic. Because never in our lifetime or people before us have they seen this big of an event that shuts down an entire state, if not the world. And what's interesting, if you read the articles about some of the areas that have reopened up, that they feel that they're beyond it, and now they're seeing a resurgence of these cases. So it's crazy. But the article went on to go say that, without something of substance, without the numbers, the information behind it, that you're just dealing with a gut reaction on how to deal with this and how to plan forward. It then goes on to say that human beings are terrible judges of odds and probabilities. And what they found is that if you ask somebody to predict what's going to happen in the future, that they are wrong, or they miss 50% of what's going to happen, because they hold it to their universe of ideas of what they think is there. And one of the examples they use is, all right, so you suffered from a flood. So the year after you bought flood insurance to protect yourself from that flood, 10 years later, you haven't had a flood. So you're looking at pinching pennies. Well, I guess I don't need the flood insurance anymore. So they stop paying their flood insurance, and then the 11th year it floods. So it talks about, planning around some of these things and understanding beyond your own universe of needs and understanding to expand your horizon. It also found that human beings by nature are overconfident in their predictions, that they think they know what they know. But obviously we don't know what we don't know. That's because we don't know. But it said that a gut feeling is a rotten way to plan. I have to tell you that I always plan around a gut feeling. It's, there's something out there that's going to hit us, whether it's the state stealing our state aid or something else, that we need to plan for an exit strategy on what could potentially hurt us and our financials and our stability. So the article went on to talk about common analytical tools, or a single tool, which is that we use averages. And I think we all do. We look back last several years to plan forward to see what is my normal revenue stream, what is, we just look at those because it's easy for us to pull that out. It also talks about the flaw of averages. If we were going to look at the average storms ahead of Superstorm Sandy, we would have had no plan. And it talks about that that's a flaw, that you need to look at the outliers. What are the ones that can completely hurt you? Look at the highs and lows. The lows aren't what you plan for. You plan for the highs. And if you use the averages, it kind of screws with your data, right? It smooths it out, makes it look nice and pretty, and you get that nice even line, but it might not be the story that you're planning around. So the next question that came up, and I added some of these weren't necessarily in the article, but natural disasters, they're not an average. Superstorm Sandy decimated part of the state. We've got forest fires, we've got floods. New Jersey doesn't so much suffer from earthquakes, but if we did, that would be another one that's a natural disaster. We do get occasional ones, they're not big. So the article goes on to talk about they have a AAA approach, and the AAAs are to accept, assess, and to augment. Now, I have to tell you that I didn't understand the augment until I went through the article and read it. Cool. And I love my geeky technology, so for that one, I really started to dig in a little bit more. And I'll explain more when we get there. The accept part, that, hey, uncertainty is inevitable. It's going to happen. But you need to plan for what's not going to happen. So when you're challenged on establishing reserves, you can say, hey, look, well, now you've got a pandemic under your belt to say, hey, look, nobody planned on a pandemic. We should be reserved better than we are. The Great Recession, who could have predicted that? In Wharton, we did a reval in 2007. Became effective in 2008, which is when the markets crashed. The housing markets absolutely crashed. So we were pummeled with tax appeals. It took us forever to get out from under them. As a result of that, we actually do an assessment maintenance program now, where we did a second reassessment because we were so close to the reval that we could do that. And then we do 20% of our town every year to adjust for market value. So we're essentially at 99% market to assessed ratio. That was something that we learned. So it was, these tools that we pick up over time. But again, who could have predicted that recession happened? And our timing was awful on that reval. With COVID-19, what's the fall going to look like? If you talk to any medical professional, they're going to tell you that the fall and next winter are horrendous. That's when the flu season picks up, that this thing is now last I read was 40 different strains of this virus. that if you were infected with the first one and you get another strain, you may not be immune to that next strain. So now you've got 40 times a virus that you have to react to. So are we prepared for next wave of hits? That's the question. So the next of the AAAs, second one is assess. What are we subject to? What's going to hurt us? We know the recession hurt us, our rateable values, so that we get pummeled with these storms. And then the other one is, what happens if you have a major employer in town shuts down? If there's an act of terrorism. What if you've got these protests and people are burning down your homes? Start to think about the realm of what's going on, and what you need to plan for is well beyond the boundaries of what we normally think about. Yep. And then, it goes into the likelihood and potential magnitude of how bad can you be impacted. And a lot of this is your own judgment, talking to your peers. We do these roundtables so we can share our ideas. This is a perfect example of taking your experience and expanding your realm of knowledge, because you're talking to other CFOs to share these experiences. And there's also national institutions that track these things. They try to predict when an earthquake's going to happen, when a flood's going to happen, if there's different things going on. So these are different tools that we should be looking to. So the final part is augment. And again, when I first read this, I'm wondering, what the heck is this augment thing? And this one says the statement was raising our expectations of risk and making sure we don't underestimate. And they refer to this tool the GFOA uses, which is called the Monte Carlo analysis. And you can find it at probabilitymanagement.org, which I went to. I downloaded the app. It's an addendum or an add-on to Excel. And again, it's a really geeky, cool tool where what you do is you take your financials and you shock them with 1,000 different variations. And you can randomize the outcome to see what's going to hurt you and what's not going to hurt you. Now, it was interesting to see, and I'm still not done learning it, and it's called probability management. I didn't put it on the screen, but it's a pretty cool tool, and I'm going through all the tutorials. And again, for those of you that know me, I'm a geek with Excel, so I like to learn new additions and things that add on to it. But this is a tool that's used by insurance companies, aerospace manufacturers, and a whole mess of other industries to predict, or at least to try and figure out what their worst case outcomes are. I mean, again, it does thousands of iterations of what could happen here. But it also talks about balancing the assumption of risk with the reserves that you establish. The greater you make your reserves, the less subject you are to the volatility. And then obviously the lower your reserves are, the more subject you are to volatility. So it's a balancing act of, we asked before, how much and how little do you have? So the other variables that impact reserving are, is the town, have you budgeted to the bone? Do you have the ability to cut expenses? If you budgeted that tight, your cutting expenses is going to result in obviously the loss of employees, because 70 to 80% of what's in our budget traditionally are salaries, because we don't make anything. We're a service industry. We do stuff. And if you don't have that ability to cut mid-year, you're more susceptible to the hits. The other one is, have you set minimums on your acceptable reserves? And we're going to talk about that in a second, but I've got another slide that'll go into this. But if you're not setting parameters on where your reserves should be, what your expectations are, it's another pitfall. And then we talked about repeatedly now the effects of climate change, natural disasters, and now the COVID-19. These are all things that need to be on our radar for things to plan around. We're going to talk, John?
No, I was going to stop you, but I saw a conclusion, so I figured you're on a roll, so keep it going. After this slide, we'll stop it for a second.
So the conclusion was local government must think about all the risks that we could face. And, until this year happened, who the hell would have thought of a pandemic this size that would have shut down the entire world? And when we saw Italy being shut down, and you watched every country in between, and then on March 16th, I think it was March 16th, the president shut down the United States. It was, I think, the 14th, he shut down air travel outside. So you watched the entire world being systematically shut down. I think it's important to identify the tools that we have at our disposal. That tool I showed you before, this probability management. I think it's going to take me a long time to learn it, but it's, I think, worth looking into so that we've got different tools to figure out which way we go. And then the other one is to put together your team. Talk to, again, the CFO Roundtable. Talk to CFOs around you, your friends, and figure out what everybody's planning for. And I think you get a better world or universe of issues that we have to deal with on a daily basis. So that was the article. The article, I think, was fantastic. There was a little bit more that I kind of skimmed over in the article, but I said to Michaela that I'm going to give her the article to share out rather than the slides, because the slides just paraphrase what the article was saying.
And I think John's just being overly modest about his, his working with this new program here, because since he started last night, he's through 5,436 of the probabilities, the 10,000 possible. So the smile on his face was huge when he talked to us off screen earlier about it. And yeah, I'd like to take a look at that too, but I don't know if I'll put as much effort into it as John will, but God bless him. He likes to do that kind of stuff. John, I don't know if you've seen the questions. We have two questions up. They're both relating in some aspect to rating agencies. And then after we answer these two questions, maybe we'll put up the second or the third polling question. So
the first one was from Bill from earlier.
Yep.
Bill, I think that the rating agencies look at your fund balance as a variable number, as a percentage of a target. Whether it's a percentage of budget or,
right.
We heard before 16.7 is the goal of GFOA at 2 months. For a AAA, they're looking for 3 months at a minimum or 24%. So yes, I think that is a constant increase. If your budget is going up, then that requirement's going to go up unless your budget's going down. And just so everybody knows that the clarification for the 3-month requirement from the rating agency is traditionally because our collections happen every quarter. So there's a 3-month gap. So that's really more of a cash flow requirement to make sure that you can pay your bills. And Dan, if you want,
when it comes to that, the rating agency with the increase in fund balance, first and foremost, they want to make sure that you have a fund balance plan in place. I can't tell you how there has been a couple of times where I've been on a phone call and, the CFO and the mayor and whoever else is on it, the administrator, just have no idea where their fund balance wants to be. So the first thing is get a plan in place, and the second thing is stick to that plan. And if that does mean constant increases in it, well, that's great because your budget's going up, so should your surplus. And when you get on these rating agency calls, you want to accentuate the positive beyond belief. You don't want to lie, but you want to make sure you put your best foot forward out there. And if your fund balance is constantly increasing, it's not a problem. Especially in the minds of Moody's and S&P.
So Chuck Kucha is now, he's challenging Bill on a number of questions, which I love here because somebody's going to outpace Bill. But he says, for those of you that have a fund balance policy, now that we're impacted by this pandemic, and your fund balance may go below your stated policy, says, how are you going to pitch this to the agencies that, you can't regenerate what you said in your policy? And I think the answer to that question is, this is something that none of us have ever seen, and that's part of your explanation. But I think as long as you have a corrective action plan to get back to your position, I think that's sufficient for the rating agencies as long as you've got a plan. They just want to see that there's something.
Yeah, I agree with that, John, wholeheartedly. This is a blip as far as I'm concerned on the radar. If you've been coming in strong year after year and then COVID-19 hits and you had a bad year, well, let's get back on the horse in 21 and start, moving it back forward again. And I can't believe that they would look back and judge us solely on 1 year if it's an anomaly based upon a multiple of good years. So
John, just so you guys are aware too, it's important that you build some flexibility into that policy. There's going to be times, as John was talking about earlier, about expecting the unexpected. Well, build some flexibility into your policy for when those things are occurring, that you give yourself a time frame to get back to where you want to be. I've seen a few of these policies, and they've worked really well. I think Morris County has an awesome policy for their fund balance and debt management, and they've built some good flexibility into it. And as one chat thing came up here also, Mike Guarino, the rating agencies are not just looking at your fund balance, they're looking at those other reserves that you've established too, which I think was a nice education thing on to them that John Rheinhardt, Morris County, and a number of other people and entities have provided to the rating agencies over the last several years.
So the next question, because Bill does not want to be outnumbered by Charcutia. So Bill asked, does the fund balance plan need to be adopted by the governing body? I've seen both. I've seen the finance committee at a minimum adopt it.
Mhm.
And I've seen other towns where they adopted it because they wanted to bind the hands of future governing bodies, which technically they're not supposed to do, but they do it in an effort to control what's going forward. I have one town that we haven't finished doing it, but they wanted to actually put in a financial best practices plan and adopt it as a new section in their ordinances so that any future governing body would take them 2 readings to undo it.
John, this is Dan. I'll just to jump in for a second. And I see there's a note on the chat that says rating agencies want to see it formally adopted. Yeah, I mean, I think when you talk to their agencies, that would be ideal for them. That's what they would like to see. But I think, the difference is that they don't necessarily live in the reality that, first of all, we all do with regards to managing finances, and they don't live in the political world that is also affected by putting an absolute policy in as an adopted policy versus a policy that is either approved by a committee or just a stated policy, in written form by the, CFO and finance officers of a town. I think my personal opinion of it is, as Bud mentioned, if you are going to do any specific policy, it needs to be flexible because things change, and you don't want to, cut off your nose to spite your face when you thought you were doing the right thing, and it just comes back to haunt you for things that you didn't even have do wrong, and here you go, all of a sudden you're violating your own policy. So my suggestion would be come up with where you think you need to be. Whether you decide you want to adopt it or not, that's up to you, but make sure there's flexibility. That's the most important part.
Agreed.
So, and while, giving a couple of shout outs, I know Elke Yetter also did a really nice policy for fund balance, debt management, et cetera, too. And I think she's on the call, so she'd be very happy to share, I'm sure.
Is that like me putting John on the spot before?
You're just making sure I was paying attention.
All right, I think we're good with questions.
Do we want to get Elka said she'll share. Do we want to get a polling question out?
Actually, it's a good time for that. Why we put Elka on. Let's see if I can get her. Elka. Elka, give it 1 second to catch up, and you should be unmuted. If not, you can unmute yourself. Somebody's got a phone call.
Oh.
Elka's live now. Elka? I guess she changed her mind, or she's having some difficulties. So why don't we remute her for the time being? Or actually, we'll leave her open until we get a response. So we've got 90% people in. Just remember, you need to answer this question in order to get your CEUs. Got, well, we're at 92%. I think we're close enough for government work. All right. Yep, we're at 63 out of 64. We're only missing one person. Come on, wake up. You almost got it. I've never seen 100% vote. We're getting gypped out of it today. There's one person that is not awake. All right. I say we end the polling, Michaela.
Well, that's a pretty good, strong polling number. It's good to see that a lot of people have begun that, and those who haven't, if you start to look into it, whether you're a client or not, if you need any kind of help, I'm sure John, loves helping people out with this kind of stuff, much like Bud and I do. If anybody needs any help, just let us know. Or if there's any questions that pop up, now is not the only time you have to ask it. So we'll be more than happy to help you guys out.
Okay, let's move on.
But John Elka said she doesn't have a microphone on her computer. Otherwise, she would be leading this charge.
That's better for us. So I'm going to minimize all the other screens.
Yep.
I can. So we talked about establishing goals of what your desired fund balance should be. And I've got this cockamamie schedule here that tries to overanalyze my current fund. Originally, we set a goal of $1,620,000. We realized it was a static goal, and it really didn't do much for us. And when we went back and changed it, we said, look, our fund balance, we're not rated, we're debt-free, so I'm not worried about a AAA rating, but we felt an appropriate reserve for us was 20%. And we also looked at our non-utilized fund balance after we'd taken the money out for our budget that we wanted to leave 6% on the table. So we knew if we stayed within those parameters, and you can see anything in red is I'm violating those parameters. And what we really did is our year that we put this in place was really 2005. That we solidified that 1.6 number, and then we changed it to a variable 20% and started to measure where were we historically and where are we now. And you can see that both my non-utilized and my ending fund balance are up and down, mostly in the red on the non-utilized, which obviously means we use too much, but there's a reason for that. And we've got a plan behind it, but we start to narrow that gap. We start to bring it down, then it comes back up. But you can see for my current fund, I'm $158,000 ahead of plan on my fund balance target, but I'm also $174,000 under plan on my non-utilized, which means I'm pushing it. But we're able to regenerate every year, as you can see from my numbers. So we're not as concerned with that lower number as long as we're able to continue that trend. The other one that we do, so we do this for every operating fund. So our water originally started off as a $850,000 target. And we decided that we were looking at a 40% target rate. And the reason why is because, water is subject to the weather. If we've got a really wet season, people aren't watering the grass. They don't spend as much money on us. So we wanted the ability to have that flex around that. And we can see that happening. The other times when we've got really dry seasons or we've got some recent contracts to sell outside our boundaries, that's been really pushing our fund balance up. So it's another great measure. You get a response from Chuck Cucci. He says he's willing to weigh in on that grant question if we want that at the end. Sewer operating, again, our original fund balance target was $800,000. We then changed that one to 40% as well. For those of you that are in the Rockaway Valley Regional Sewage Authority, for our sewage, you know that we've been getting sued by Jersey City for years, trying to get out of their agreement. So what we were doing is we were planning for the lawsuit if there's a negative outcome. We were also planning for, if they had some big increases, because we know their capital projects are going through the roof and our rates are going to go up. So we again set a high target for that so we can buffer against immediate increases and delay the impact on our residents. And again, the low end of that was 6%. So that's probably the one that I've been the most ready to meet. We're meeting the upper and lower thresholds. We're only $13,500 off from the fund balance target. That's not so bad. And we just picked up another big development, which is going to help that revenue come through. So over the next couple of years, that one's going to be flush. My special district, which is a garbage collection district, I have a lot more red. And the reason that happens here, and we understand it, is it's cyclical. That every 4 years we buy a new garbage truck. But in the off years, we allow the fund balance to increase enough so that we can pay for that garbage truck in cash every 4th year. We run 3 trucks. They have a 12 to 15 year useful life of when they're finally dead. And So that's why our plan turns red in the middle. So we can absolutely see that cycle of cash flow or fund balance build up over time. So that's just one way that we've been dealing with this. And you know, this happened before this article came out. We started to come up with this tool, but we've really just fine-tuned how we plan over time, and we took it back historically to see how we would have performed. So that's just one measure. The next thing that I wanted to talk about is, let me find the right sheet here. For those of you that are GFOA members, you've seen this before. We do and we've shared it all over the place. It's a tool that if anybody wants it, I'm willing to share it. Anybody's willing to share that has this thing. About your financial trends. The source of this, and I put it on the left-hand side, the source are your annual financial statement, your audit schedules. In this case, it's your revenue schedule. And just collecting data over time along with your census data. Revenue, expenditures, and it's just anything that's in blue is what you fill in. Everything else is not as a calculated field, the black fields. After you've done that, you're able to generate automatically. It feeds the rest of this. The only thing you'd have to update are the titles. Obviously, you don't want to say Borough of Wharton. You want to say, but it creates all these different analyses. So I'm going to go over these differently rather than doing it through Excel because it's a little bit clunky. And I'll go through what they mean. The other thing that we do is we do a 5-year budget projection. So we take the historic, and I haven't updated this year. We've been a little busy with the pandemic. So we're a little behind, and it's going to significantly change what I do with some of these scenarios. So we'll be working on those. We do a 5-year tax rate projection, and it's got a bunch of assumptions that we plug in on the side so we can see what we've done. It assumes certain amounts for the county, for the schools, what our rateable base is growing by. And it predicts those tax rates so we can see what's going to happen to our residents. The next part of this is we look at a budget summary. This is supported by all underlying schedules, but here we have a synopsis of where we think our revenues are going to go. We assume for purpose of this that we don't have any grants. For the most part, grants are offset by themselves, the revenue and expenses, unless there's a match. And the match on some of these is insignificant, so we just assumed there was 0. So we assumed all these, and we have an annual average increase on the far right. We then do the same thing with our appropriations, and we come down to the final budget to see what we're looking at as an increase year over year. Our projection when we did this last time was we were going to see a 2.47% decrease in our budget. Most of that had to do here with the capital improvements. I talked about redeploying those reserve for sale of municipal assets. Well, we pulled $300,000 out of that number, and for this year we put it back in. We've got a fire truck on the horizon and thought that was a good investment for us to redeploy those funds. So you can explain what goes on with each one. We then parlay this into a levy cap calculation that predicts going forward if we're going to see any pressures, and it takes every one of the components of what you do in your levy cap and it predicts them based upon your projections. So a cool tool we found here is we had appropriated in 17 $300,000 of that reserve for sale of municipal assets money, and we decided to cancel it. We didn't want to do that project that year. As a result of that cancellation, we had a negative adjustment to our levy cap calculation in the next year, which when we looked at it was going to hurt us significantly. We were able to take all of our levy cap back, distinguish that, so it essentially moved all of that banking forward for us. Mm-hmm. It was a pretty cool trick, but it worked well when we did it. And we're predicting forward, and we can see if there's any pressures, which we're not. We're running pretty lean, but we're able to survive. The next part of this is we look at the revenues in detail. So it's the same thing you saw on the other sheet, but we only show the summaries. Out here, we're actually going into the detail of what we're doing with each increase and looking at a 5-year average. So having those numbers over here on an individual basis of where we theoretically see some spikes and not. Obviously, in 2020, I don't think I'm going to see a 2% increase in my interest. I probably should have had a negative number there to have that drive that down. That's a little too late now. What we do is we take each one of these categories and drive them based on what we think is going to happen. think your permits have stopped. Mine are actually, they're blowing up. We've got 3 redevelopment projects that are going through. They're not stopping. They're taking advantage of the time, and they're pushing them forward. So growth, we're going to see. And again, you do this with each one of your individual items as to how you see this growing or shrinking over time. And then that yellow here is, we know that your amount to be raised by taxation is a plug number. Whatever you can't support with revenues is going to be in the form of taxes. And we've been managing this number here pretty closely. So it fits within the levy cap calculation.
John, I don't know if you're seeing the questions or not, but there's 2 more that have popped up. One of them I just saw go up the screen about anticipating water and sewer. It looks like you do anticipate surplus coming in from water and sewer on an annual basis.
We do.
Do you sell to, do you have to report to the BPU? Do you sell to other municipalities?
I keep below that number.
Okay. Just, yeah, because that's out there, and I know that came up recently with one of my municipalities. You know, it's you can only, if you're selling to other municipalities, 5% is the threshold, 5% of the budget. So make sure you keep an eye on that. And then there was a question about your RUT with in 2019. I don't know if you have the answer here or not.
What was the question?
Question is, in 2019, your 2019 adopted budget, your RUT was 814,000. What was the 2019 taxes receivable at year end? So how close were you to your uncollected taxes number?
So we manage our tax collection to about 98.5%. There's 1 year my tax collector got 99.5, and I was not happy. I like a little delinquency. It gives us extra revenue for the interest. So we manage around the percentage of collected, not necessarily the residual balance.
Okay.
And once she hits that 98 range, I ask her to stop. Stop leaning on the residents, stop leaning on the businesses, because we don't want to exceed that, because obviously then we've got to plan around how to deal with the delinquent revenue.
Yep.
The RUT, we've been growing by about 2% every year. And you'll see in the next, when we look at the financial trends, that we corrected that trend. We had a downward trend, but we wanted to maintain it at a certain percentage of the total. Because we manage our RUT as a percentage of the total levy, including the schools in the county, not just our own budget. Because obviously it's there to buffer us from that. So we grow that at about 2% a year. So that's what we do here for our budget projections. What I'm going to do is I'm going to go back to the other schedule here, which is we take both of these things together. We put together a little program here called the Financial Trend and Financial Projection Program. And we came up with a little saying, ensuring the Borough of Wharton's financial future. And it covers a range of 2014 to 2024. It's a huge range. And obviously anything beyond a year or two in the future doesn't make any more sense, but at least we can start to plan and identify peak valleys. Again, I'm that geeky one. I had to put together a table of contents to describe where everything was. And go through and explain. We have an introduction. We explain all the indicators we track. We have a glossary of terms so they understand what we're talking about. And that we put together traditionally before we ever entertain the budget. We've got our financials done in early January. We put this together. We show the finance committee where our performance is, where they need to focus. And we go over each one of these trends. And, we've got operating revenue per capita. We track that. We look at the changes. We look for significant changes here. Revenue as a percentage of total operating revenue, we're declining. We've found alternate sources of revenue that help us push that number down. In the state of New Jersey, that's difficult because we're told with what we can use in other revenues. And then we compare them against different factors, tax revenue against the budget. State aid, we know, is a declining factor because if they're static and haven't changed since 2011, then obviously it's a lowering. If your budget's going up, it's a decreasing position over time. Grant revenue, it fluctuates significantly depending upon what you've got in, whether or not you just do your bare bones and then do the rest by Chapter 159s as the year develops. Looking at property tax revenue, is there significant changes? While these look like they're huge, the scale makes it look huge, but we're talking, we had a decrease and we had some minor increases. Valuation change. We came off of 2008 we got pummeled It's several years of continued downward decline, and now we're in an upward tick. And we're seeing, into 18 was 3%. We saw a little bit greater than that going into 19 and 20. So we're pretty happy with the recovery, and we can see it's absolutely changing. Property tax revenue per capita. If we have time, actually probably won't have time for the other one, but we'll end on these when we're done. But these are different ratios that you can use. Your outstanding property taxes receivable. I told you that I like to keep a certain percent. But, right around 1.3 is ideal. She got a little aggressive a couple of years ago. We're maintaining that where we want it to be. So it's pretty flat and it's managed. Expenditures per capita, we try to benchmark where we are. Are we spending too much, too little? We've had some corrections. We've had some anomalies in there where the total expenditures include a one-time purchase, which happened here in 16. But if you take that out, we're actually flatlined. Net debt as a percentage of the 3-year average equalized valuation. That's bragging rights. We worked on this for the last 18 years, and in 16, we achieved debt freedom in our general obligation, except for one small loan, which is done through open space. And we've tailed down that we're now below 0.01% because we have one small EIT loan that's got to go away. Then we look at debt service as different factors, but once we went to zero, these really didn't make sense. They just started to look ugly, this is the other measure we talked about, non-utilized fund balance as a percentage of budget. You could tell that we started to push it in these couple of years, and then we flattened it. We were pushing our luck, and we started to bring it back up, so it's going to grow again. Again, we had some one-time redeployments that we wanted to factor into our long-range planning, and we've got a plan that goes with it, so it's just not handling. Capita, change in fund balance, cash balance. Looking at cash flows, again, this is the 1 year we took $500,000 out and bought a bank that went out of business in the center of town, and we wanted a central parking lot, so that's what we did there. This is the one that I think is one of the most important, and it's the spread between what you bring in and what you spend. So the more your governing bodies or you as CFOs compress that and tighten your budget, the tighter that margin is, the less money you have regenerating fund balance. So that's a great measure. I've only in one town seen that invert, and it was a little bit of a crazy situation, but they had thought that if they cut everything to zeros that they were fine, and they had some serious cash flow problems. Looking at the equalized valuation per capita, we can see that the town went through that dip and has now recovered, and it's on its way back up. Fund balance as a percentage of the budget. We've leaning on it, but we came off that peak and we're back down. So that's, again, we've been metering that and monitoring what we use. This is one of, I think, if not the most important slide here, is your fund balance as a percentage of prior year results of operations. This is how much money you anticipate in your budget, percentage of what you generated in the prior year. And we know that we really shouldn't use any more than we're able to regenerate. So you can see here we were low. We pushed it a couple of years because we had some projects we wanted to do, and we brought it back down. But now we're back down to under 100%. So regenerating our fund balance. So to me, this is one of the best slides out of the entire deck. And I was talking before, I think there's a question as to when we our rut, what is our measure? What are we looking at our outstanding taxes? I'm not. This is the measure I want. I want to maintain this at 3.87%. Same percentage over the total levy. To me, that is the truest measure of what we can do. And then we maintain stability in what we do with our collection. Again, this is just the data that supports it. And what we do is, as part of the report, we go into the projections, we give a little definition, a little narrative on where we are, what's going on with the town, and then we present only the summary of the schedule. So it's the tax rate, revenues and appropriations in summary, and then the levy cap calculation. Now, you may ask, why don't I provide the detail? Well, if you've ever gone through negotiations and they've gotten hostile, you don't want to give too much information to the unions to use against you in negotiations. So everything else I have underneath this is deliberative because it's always moving based upon what's going on with the environment. Right. But the synopsis is what I present to my finance committee and sometimes the entire governing body if they're looking for an update. But those are some of the tools that we use here in Wharton. And obviously you saw the national tools from GFOA National, but I think it helps in planning and predicting what's going to go on in your future. No questions?
You know, John, one thing I just wanted to bring up real quick. I was going to go through local finance notice 2020-13 about the extension of deadlines, but it's pretty self-explanatory. If you haven't seen it yet, check it out. It was issued on May 27th. And obviously, if there's any questions, please get back to us. We are not recommending that you go far out on extension of deadlines, especially when it has to do with your cash flow, like the estimated tax bills mailing. The deadline got pushed out to the July 31st. You know, the whole point of putting out estimates is so that you can improve cash flow. So why would you hinder it by going out to the 31st? You know, if you can stick to your original deadlines, please do so. I know us in the office, we're trying to do the same thing. So hopefully your audits are being issued as well. And if not, there's a plan in place to wrap you up before June 30th. But state is suggesting that September 30th could be the deadline, or they did extend the deadline to September 30th for that. But no, we're trying to get everything done by June 30th. So bear with us as we try to get through.
Do we want to do that final polling question?
I got a question from Bill before we go. If you want to, are your audits now extended to September 30th? Yes, they are extended to September 30th. However, we're in-house. Nisivoccia is still keeping the June 30th as the deadline, and we are trying to get all of our reports out the door before that. There might be about 5% that don't make it out by June 30th, but they will be out shortly after.
You're about 50-50 on the answers.
It's good. It does good for you to get an audit report 9 months after the end of the year, as far as I'm concerned. You know, especially if you have recommendations in your report and you have to start addressing some issues. What good is it getting it with 3 months left in the year? But state knows better than I do.
Okay. I don't see any more questions. $47 yes, 53 no. Share results.
There we go. Pretty split. We're in June, so hopefully more and more are going out the door. Any other questions out there?
I think they're ready to eat lunch.
Yeah, I think so too. All right. If you don't want to go, I'll just thank everybody for coming out today. We enjoy holding these, and we hope you get something out of it. Even if you learn one little thing, it's something you can take away with you and maybe apply it to your own municipality. Again, any questions that come up, you know, any of us here on the board will be more than happy to answer anything you have, and we appreciate you taking your time and coming out with us today. I'm looking outside. I see my pool in the back and blue skies above, so I think I know where I'm going after this. But again, be well, everyone. And again, thank you so much for joining us today, and we look forward to seeing you in the future as well.
All right.
One more question? No, thanks. Thanks, Bill.
Thank you, Bill.
Laura, there's going to be a survey.
Yes, Michaela will send out a survey and a link to the video. No real presentation today. And the FAQs we'll get from Dan, and we'll post them. Yep. If you can, fill out the survey. Any future topics you have in mind, please put them down. We like to read them, and we actually like to develop these seminars after your comments. Good.
Great.
All right. Thank you.
Thank you, everyone.
Thank you.
All right. Talk to you soon.
Okay.